All right, what's up, guys? What's up? I'm glad you're joining me on this next video segment of the Financial Freedom Formula. And guys, if you haven't been watching the webinars or the videos up to this point, you're missing big time, because what I'm showing you and what we've been showing you in these last few videos is how you can achieve the financial goals that you want in your life, systematic, formulaic, every single month after year after year after year. And our goal is to help you achieve financial freedom in 10 years or less. Now, it's really simple when you understand one thing. Number one, well, I guess a couple things. Number one, what doesn't work. And that way you can eliminate most of the noise and the distraction out there. And you can concentrate on what does work, right? And with that focus, it'll help you understand exactly what you should do in your financial plan to achieve results. And at the end of the day, that's all that really matters. Real, tangible, measurable results. Cash flow coming into your account. So our goal with Financial Freedom Formula is to show you how you can achieve financial freedom in 10 years or less. And financial freedom is simple. When the assets that you've accumulated produce enough cash flow or income that exceed your expenses, you are financially free. And that's really our goal. So we've got a 4-step process, and the last few videos, I've been in step number 4 with you. We're going to continue on in step number 4. And what we're going to do is we're going to continue diving in to how you can use one of the most misunderstood but yet one of the most powerful tools out there, a cash value funded, maximum funded life insurance policy to literally be your own bank. Now, for real estate investors, this is amazing. Most of our clients, so many of our clients are real estate investors, because where else would you want to put your money? We've gone through several examples of that here. But what I'm going to do is I'm going to really pull back the curtains today in becoming your own bank, and we're going to go into the math, the numbers behind exactly how this strategy works, okay? So last time we talked about the uncommon approach, we talked about Einstein, we can't solve problems with the same level of thinking. We talked about our 2 options, the downside of using cash or debt, and how we really want opportunity, or we want our money to be compounding and to be able to leverage and utilize that money every single day for anything we want. So today, what we're going to talk about is how you can take a private loan through a cash value life insurance policy and keep your money private, in your control, and actually have your money compounding and growing. So I'm gonna flip over to another chart where I can actually do some math with you, and here is what we will dive into. All right, let's dive over here. So last time we went through this whole stair-stepper approach of the downsides of using cash and or debt, and how we ultimately end up in the same exact spot where we have to spend the same money over and over and over again. And I can't even tell you guys, if you take a look back on your life, how many times have you funded vacations? How many cars have you bought? How many Christmases have you lived through and funded? And how could you do it differently? How could you achieve those goals of having those expenses, really using your money to develop and create the life that you want, but also achieve your long-term goals? And so I shared with you the theory of this with this little graph here. Now what I'm going to do is I'm going to share with you the math. So on the next page here, this is exactly how a policy loan works. Now I'm going to start off with a really, really simple example to prove a point. And the next time what we do is we're going to dive into how this is used for real estate. So let's say you've built a maximum funded cash value life insurance policy, and in your policy, you've got $25,000 of cash value. Now, if you're unfamiliar with what this is, watch some of the previous videos, but the cash value is the equity or the investment portion of a life insurance policy when it's built to have cash value. Now, this cash value has some very unique opportunities. In fact, when you take out one of these policies, you become a guaranteed partner with the insurance company, and written into a contract is you can take a policy loan at any time for any reason. So let's use a very, very common approach, right? Now, let's say you're going to buy a car. Now, I'll be honest with you. I've never used my policy to buy a car, ever. You can do that, but what I want to demonstrate here is how powerful this strategy actually is. So let's say you use your policy to buy a car, because the only other 2 options that you would have is you could use bank's money, take a loan, or you could use cash, right? So let's say you decide to take a policy loan for $25,000. Now, here's how this works, and this is the genius behind it. The policy loan actually comes from the insurance company. Insurance companies have millions of dollars in a very liquid state, and you actually take the policy loan directly from them. What they do is they use your policy as collateral. Now, the beauty of it, it is a life insurance policy. And the insurance company, they know that they owe you money. So if you took a policy loan today of $25,000, you went out and you bought your car, your money is now doing goal number 1. This is our short-term goal, what we wanted our money to do, right? But if you died with your loan outstanding, the insurance company, they already know that they owe you money. So they're going to use your death benefit as collateral. If you die, they pay out the death benefit minus the outstanding loan. Now, when the loan comes back from the insurance company, or when the loan comes from the insurance company, they don't ask you any questions. It is literally a private loan that you control 100%. They don't ask you what you're using the money for, if you're going to make policy loan payments, if you're going to make any payments, when you're going to make payments, how much those are going to be. It is 100% literally a private loan between you, a private individual, and a private life insurance company. You control it from beginning to end all the way through. Real estate investors love this. I love this. I don't have to prove any credit checks. I mean, I control this 100%. Now, the insurance company, they're actually going to lend you their money. And with these insurance policies, it's kind of interesting. These companies are mutual companies, meaning that they are mutually owned by their policyholders. If you have a policy with a company that I have a policy with, and I take a policy loan and you don't, if the insurance company does not charge me an interest rate, you're going to be less profitable. They're going to make less money on their investments than they otherwise would have. So today, most insurance companies that we represent, they're charging you about what they're earning. So today, most insurance companies are earning about 5%. Now, some of these rates are a little bit higher and a little bit lower depending on the insurance company. But let's just run through the math. Let's say that we're taking this policy loan and we're going to treat this car payment, this policy loan, just like we're paying off a car. And we're going to pay it back over 5 years, okay? Now, again, you get to control this 100%. But here's one of the ideas that I like with this concept. If you've ever seen the movie Spider-Man, you'll get what I'm saying here. In Spider-Man, when Peter Parker gets bit by the spider, his uncle realizes that Peter's got something going on with him. And he says, Peter, with great power comes great responsibility. And that's exactly how it is with this concept. You have all the power in the world, and you want to use it responsibly. So let's say, and I've pre-populated this calculator here, let's say that you're going to pay this thing off just like a normal car payment. So what I've got in here is a $25,000 loan, 5%, and I'm showing you making monthly payments. Here would be your payments, and here is how your payments work mathematically. Now again, you could make a payment from $471.78 today, and then skip for the next 5 months, and start all over again, and make a $1,000 payment, and a $20 payment, and a $2,000 payment. You control it 100%. But here's the math. The first payment that you make, $367 goes to principal. That principal amount reduces your loan balance from $25,000 down to $24,600. Now and so the rest of that money, the rest of that payment went to interest. That interest literally went to the insurance company as an expense, right? So now next time you make a payment, because your loan balance is smaller, it went from 25 down to 24.6, the same payment, a little bit more of the payment goes to principal and a little bit less goes to interest. And what you'll notice is every time you make a payment, more goes to principal, less goes to interest. It works just like a mortgage. So at the end of all of this, if we follow this all the way down and you make every single last payment exactly as I'm showing you here, you would have paid the insurance company $33.07 in interest cost associated with this loan. So $33.07, and we're going to put this as your cost. Okay, now the reason I draw the triangle like this is it represents the way those payments were flowing. In the beginning, more of your payment was going to interest. Over time, less to interest, more to principal. But that is a cost. Now, here's the benefit, right? Why most people, when they look at this on the surface, they say, why would I pay the insurance company to use my money, right? I've put that money in a life insurance policy. It's my money. Here's the beautiful part, and this is the math behind it. Your $25,000 never came out of your policy. Your policy was just used as collateral. Now, the insurance companies that promote this strategy, that facilitate this strategy, they're always going to keep these two numbers about the same. So in this example, you're going to be making 5%, but you're paying 5%. Most people on the surface, they would say that's just a wash. There's no benefit for doing this, but the benefit is the difference in the type of interest that you're paying, simple, and the type of interest that you're earning. Here is the difference, here is the beauty. Over this same 5-year period of time, your $25,000 in the first year earns 5%. You earn $1,250. That $1,250 rolls into your cash value. It becomes part of your contract. You'll never lose it. But now next year, you're earning 5% on $26,250, so you're earning interest on a little bit more money. So you earn a little bit more interest, and that interest rolls in, and so on and so forth. And during this same 5-year period of time, the amount that you're earning goes up, the amount that you're paying goes down. And in this example, you would have earned $69.07 in compound interest. Now, I hope you got that, because this is the beautiful part about this. During this period of time, your money is compounding, it's growing, right? But now you've earned $69.07 in profit, but here's where your money just did two things, right? Your money never came out of your policy. So the difference, your profit in this example is you got your car, but now you walked away with a $3,600, let's see if I can write here, $3,600 profit in between your costs and your revenue. Compound interest is going up, simple interest is going down. You come out profitable, and here's the huge benefit. We talked about compound interest being nothing more than a function of time. What if we went back to this same compound interest graph here, and let's say your money compounded for the next 40 years. That $25,000 earning 5% every single year. In this example, it grows to $176,000. Now, if that money were anywhere else, right, it'd have to sit there. You couldn't do anything with it. You'd have to forget about it. If you wanted your money to compound and grow, it'd have to sit there. You couldn't touch it, and if you did, it would break the compound interest curve. With this example, you can get to the same end goal, but you can use your money all along the way. So the question truly becomes, what will you use your policy to create? And as I mentioned, our clients have used this to create all kinds of wonderful things, from starting and launching and running businesses to buying real estate and everything in between. So in this financial freedom formula, you're going to have all of the math that we just went through. Here's the calculator that I've uploaded in there. Here's the math, all of the numbers that we just went through, everything that you need on to really prove this out for yourself. So if you want this financial freedom formula, it's really simple. Text cash flow, one word, to 797979. Cash flow to 797979 and get your roadmap to financial freedom. I'm going to show you blueprints step by step where you are today, where you need to be, and exactly what to do to bridge the gap. So guys, this strategy works. I know it works. Hundreds of clients that we work with know it works. I can't wait for it to work for you. Have a great day.